There's this one statistic in the mortgage world that always it kind of blows my mind. A huge number of home loans, they get denied.
Right.
It's not because the borrower's broke.
Right.
And it's not even because the person can't really afford the house. They get denied because they applied for the wrong type of loan or the lender just didn't know how to structure the income correctly.
It is the classic square peg in a round hole problem. I mean, it's the difference between a hard no and just.
Yeah.
Not structured like that.
Exactly. And that's the tension I really want to dig into today. We're looking at this massive gap between what I call the algorithm, that one-click online approval that promises you the world in 30 seconds, and the architect, the human lender, who actually knows how to build a file so it survives underwriting.
That is such a critical distinction. And to do that, we are doing a deep dive into a firm that's been surviving the volatility of the Florida market since 1996. We're looking at Ace Mortgage Loan Corp, based out of Coral Springs.
And 1996 is a key date here. I mean, think about what the market has done since then.
Oh, wow.
It means they navigated the dot-com bubble, the huge 2008 crash, the pandemic boom, and now the current rate hikes.
Look, if you are still standing after 2008 in the mortgage industry, you're not just lucky.
Yeah, well,
you have systems. You have to be doing something fundamentally different than all those churn and burn shops that just vanished overnight.
So here's our mission for this deep dive. We've got a whole stack of sources here, reviews, articles from their team, and especially some really interesting myth-busting by a guy named Scott Osher.
And their loan menu.
And their full loan menu, right?
There.
We're going to decode the jargon, obviously. But I really want to focus on the strategy. How do they handle what they call the impossible files? And I want to challenge this whole idea that the interest rate is the only thing that matters.
Oh, we definitely need to talk about the Friday night panic, too. That is a recurring theme in these sources that I think every single listener needs to hear about.
We will get to the panic, promise. But let's build the foundation first. I want to look at their loan menu. Because usually when I look at a bank's website, I just see a list of acronyms and my eyes just glaze over.
It's an alphabet soup.
It is. It feels like I need a Rosetta Stone just to figure out what I qualify for. ACE sets this out pretty clearly, but let's peel back the layers. Let's start with the baseline, the conventional loan.
Right. So this is the benchmark. When you hear conventional, you should think Fannie Mae or Freddie Mac. These are loans that conform to the standards set by those government-sponsored enterprises.
Okay, but just to play devil's advocate here, why does it matter if it conforms? Why should the borrower care?
Because if it conforms, it's easier for the bank to sell it on the secondary market.
Right.
And that liquidity is why these loans usually have the most competitive rates. But, and this is a big but, because they're so standardized, they have very, very strict boxes you have to fit into.
The perfect borrower box.
Exactly. Your credit score has to be above a certain number, your debt-to-income ratio below a certain percentage. If you fit in the box, great. You get the vanilla product and it works perfectly. It's really optimized for people with W-2 income and amazing credit.
But, I mean, looking at the data, fewer and fewer people actually fit that perfect W-2 employee with an 800 credit score box anymore.
Not at all.
We have gig workers, entrepreneurs, people with past medical debt.
Yeah.
So ACE highlights FHA loans as the alternative. Now, be honest, is FHA just the bad credit loan? Is it like a badge of shame?
No, and that is a massive misconception. It is not a badge of shame. It's a strategic tool. FHA stands for the Federal Housing Administration. The key mechanism here is that the government insures the loan for the lender.
Okay, so the government is basically so-signing.
In a way, yeah. Because the government is taking on the risk if you default, Ace Mortgage can approve a borrower with a much lower credit score, sometimes down to 580, or a much smaller down payment, usually around 3.5%.
So it just drastically lowers the barrier to entry.
It does. And Ace seems to position this as the main vehicle for first-time buyers who haven't had, 20 years to build up a perfect credit history. It's all about accessibility.
Okay, so there's one category here that stood out to me because the reviews were so incredibly specific about it. A client of theirs, Margaret Fouts, specifically praised their depth of knowledge on VA loans.
Veterans Affairs loans. It's arguably the most powerful wealth-building tool in the American mortgage market, and it is criminal how often it is misunderstood.
Why is it misunderstood? Is it just too complex?
The paperwork is unique, and frankly, a lot of generic lenders just don't want to deal with it. But look at the benefits that ACE highlights. 100% financing.
Which means literally zero down payment.
Zero down. And crucially, no PMI.
Pause there. We hear PMI thrown around all the time. Define that for someone who hasn't bought a house yet.
Right. It's private mortgage insurance. Usually, if you put down less than 20% on a home, the bank makes you pay an extra insurance fee every month.
To protect them.
To protect them if you default, it's just dead money. You never get it back. VA loans waive that requirement entirely.
Wow. That could be hundreds of dollars a month in savings.
Easily. And over the life of a loan, that's tens of thousands of dollars. So if you have a lender who doesn't know how to navigate the VA's specific residual income requirements, you might get pushed into a conventional loan and just lose that benefit. Margaret's review suggests ACE really knows how to maximize it.
Okay, then we go to the complete opposite end of the spectrum. The jumbo loan.
The luxury tier.
Right. This is for houses that are just too expensive for Fannie and Freddie, right?
Correct. I mean, in 2024, the conforming limit is pretty high, but in places like Coral Springs or Parkland, you can easily go over it. And when a loan is jumbo, the government doesn't back it. The bank usually holds it on their own books or sells it to private investors.
Which implies the bank is taking on a much, much bigger risk. I mean, if I default on a $2 million house, the bank is on the hook.
Exactly. And because the risk is higher, the scrutiny is higher. But here's the nuance. ACE describes their approach as investor-friendly and flexible. That tells me they're doing what's called manual underwriting.
Manual underwriting. That sounds so archaic, like someone with a green visor and a calculator.
It's actually a premium service instead of an algorithm just saying computer says no because your income fluctuates.
Yeah.
A human underwriter actually looks at your full portfolio, your stocks, your assets, your business cash flow to make the deal work. They look at the whole picture.
So it's a human making a judgment call based on common sense, not just a credit score trigger.
That is the defining difference in the jumbo market. You need a human advocate.
Okay, so that's the what. We have the tools.
Mm-hmm.
Now I want to shift to the how, because you can have the best products in the world, but if the strategy is wrong, the deal falls apart. There's a series of articles in our source stack by Scott Osher, seems to be a senior voice at ACE, and he tackles the one thing everyone fights about, the interest rate.
The barbecue conversation killer, as I like to call it.
Right. You're at a party, you mention you're buying a house, and your neighbor goes, whoa, you're paying 6%. I got 2.5% a few years ago.
Or, I saw an ad for 5%.
And suddenly you feel like you're being scammed.
It's the most common source of buyer's remorse, and it's almost always based on bad math or just a total lack of context.
But wait, if I see an ad for a rate, why can't I just get that rate? Scott Osher has an article titled, basically, But My Neighbor Got. Explain his argument to me. Why is the advertised rate a myth?
Because bankers don't just spin a wheel to set your rate. Rates are determined by the bond market, specifically mortgage-backed securities. But, and this is the key insight Scott provides, your specific rate is adjusted by something called LLPAs.
LLPAs, that sounds like a medical condition.
Loan level price adjustments. Think of it as a risk scorecard for you, the borrower. Your neighbor might have a credit score of 800. You might have 740. Your neighbor might have put 40% down. You put 5% down.
So every little flaw in my application adds a tiny bit to my rate.
Exactly. Or your neighbor might have paid points, which is basically an upfront fee to buy their rate down. So they paid, say, $10,000 at closing to get that 5% rate, while you paid 0 points for a 6% rate.
So comparing your rate to your neighbor's without seeing their entire financial DNA is...
It's apples to spark plugs. It makes absolutely no sense. Scott's point is that a good mortgage partner explains why your rate is what it is. They show you the math. They say, look, if you can improve your credit score by 20 points, the LLPA drops and your rate actually gets better.
That's a huge distinction. Instead of just giving you a number, they give you the lever to change the number.
Precisely.
And that leads perfectly into the nightmare scenario. There's another piece here called Are We Closing Tomorrow?
Oh, this is the one that gives me secondhand anxiety just reading it.
The setup is so visceral. The moving truck is loaded. The kids are strapped in. You are driving to the title company to sign the papers. And then the phone rings. We can't close.
And suddenly, you're effectively homeless with a truck full of your life's possessions. The article talks about the internal rage that causes.
Yeah. So Ace Mortgage claims this shouldn't happen. They draw a hard line between a pre-qualification and an accurate approval. Now, be real with me. Is there actually a technical difference there, or is that just marketing speak to sound better than the big banks?
No, the difference is massive. It's the difference between a guess and a guarantee.
Okay, break it down.
A pre-qualification, which is what you get from most online calculators or those big box lenders, it's based on unverified data. You tell the website you make $100,000. You tell them you have $20,000 in the bank. The website just says, great. Based on what you said, you can afford this house.
But nobody actually checked.
No one checked your pay stubs. No one called your employer. No one verified if that $20,000 was a gift from your parents or a loan from your sketchy uncle.
So it's a pinky promise based on a rumor.
It's worse. It's a hallucination. An accurate approval, as ACE calls it, or a fully underwritten pre-approval, means an actual human underwriter has looked at the documents. They've calculated the debt-to-income ratio using your tax returns. They've verified the source of your down payment. They have done the financial autopsy before you even make an offer.
So when Scott Osher talks about avoiding that internal rage, he's saying that rage is completely preventable if you do the hard work up front.
Exactly. And in a competitive market, a seller knows the difference. If I'm selling my house and I get two offers, one with a flimsy prequal from some website I've never heard of, and one with a fully underwritten pre-approval from a reputable local lender like ACE, I'm taking the second one every single time, even if the offer is slightly lower.
Because you know it will actually close.
Yes.
Certainty has a dollar value.
Certainty is everything in real estate.
So that brings us to the consumer protection angle. There are notes here about the CPFB, the Consumer Protection Financial Bureau, and something called the GSE patch. We don't need to get bogged down in the legislation, but why is ACE even talking about this? Why should a listener care about a patch?
It signals they're watching the regulatory horizon. The mortgage industry changes rules constantly, deadlines for government backing shift, and if your lender isn't paying attention to, say, the GSE patch expiration date, you could end up in a loophole where your loan becomes unsellable the day before closing.
So you really want a nerd in your corner?
You want a nerd who reads the Federal Register every morning? Yes. You do not want to be the one discovering a loophole.
Let's pivot to the people, because all of this technical stuff, the underwriting, the LLPAs, It requires a human to execute it. And looking at the reviews, one name just dominates the conversation: Kelly Ardito.
It is rare to see a single loan officer mentioned so specifically and so often in a company's reviews.
I want to look at the case of Amanda Monks, because her story isn't just Kelly was nice, it's a roadmap for fixing a broken file.
Amanda's situation is what we'd call a fallout file. She'd already been denied somewhere else. And she admits in her review she had downright horrible credit.
Most lenders would just hang up the phone. They'd say, sorry, call us when your score's up.
Right, because that requires work. But according to the review, Kelly didn't say no. She built a plan. This is likely what we call credit simulation or rapid rescoring.
How does that work?
Well, a lender has tools where they can simulate scenarios. They can say, okay, if Amanda pays down this specific credit card by $500, her score will go up 20 points. They give the client homework.
Do A, B, and C and come back to me.
Exactly. And Amanda did it. The review says once the score hit the mark, they got the pre-approval in 24 hours. But the part that I loved, the quote that stuck with me, was what happened at the very end. Amanda says Kelly dragged the title agent to the finish line.
That is a very specific, almost violent image.
It is.
It implies the problem wasn't the money anymore. It was bureaucracy.
Oh, title issues are incredibly common, especially in Florida. Maybe there's an open permit on the roof from 2005, maybe a lien from a contractor. A typical bank lender just sits back and waits for the title company to fix it. They say, not my job.
But dragging them to the finish line implies Kelly was on the phone, harassing the county, coordinating the paperwork, basically doing the job of the title agent to make sure her client got the keys.
That's the difference between service and partnership. A partner does not let the deal die on someone else's desk.
It really is. And it's not just Amanda. Look at Miriam, the teacher. She used the Hometown Hero grant.
Right, this is a Florida-specific program, isn't it?
Yeah, the source material mentions it specifically. It provides down payment and closing cost assistance for essential workers, nurses, cops, teachers. But I've heard these programs can be a nightmare of red tape.
They are administratively heavy. They require extra compliance layers, extra approvals.
So a lazy lender might just not mention it.
Or they might mention it but then screw up the execution, causing a huge delay. Miriam's story shows that Ace Mortgage is comfortable layering these complex government grants on top of standard loans. They're maximizing the client's capital, even if it means more work for them.
Okay, now we have to talk about logistics.
Yeah.
Because real estate does not happen between 9 a.m. and 5 p.m. on weekdays.
No, you go to open houses on Sunday, you get into a bidding war on a Saturday night.
Ace advertises availability 7 days a week, from 9 a.m. to 9 p.m. And there's a review from Raquel Maldonado that explicitly mentions Kelly answering texts on weekends. Why is this strategic? Is it just convenience, or is there a real tactical advantage?
Oh, it's huge. Imagine you're in a bidding war. It's Saturday at 4 p.m. The seller says, we have another offer. We need your highest and best by 6 p.m. Can you close in 30 days? You need to ask your lender right now, can we do 30 days? Can I go up another $10?
If you have to wait until Monday morning to ask that question.
The house is gone. You lost.
So accessibility is a competitive advantage. Speed is currency. And location matters too. They're physically located on West Sample Road in Coral Springs. In the age of Zoom and DocuSign, does being local actually matter anymore?
In Florida. 100%.
Why specifically Florida?
Because of the insurance and the condo markets. A lender sitting in a call center in Nebraska doesn't know which condo associations in Coral Springs have fully funded reserves and which ones are about to be hit with a massive special assessment for a new roof.
So they might approve a loan on a building that's actually a financial time bomb.
Exactly. A local lender knows the buildings, they know the unwarrantable condos, they act as a second pair of eyes on the asset itself. They can stop you from buying a money pit because they know the neighborhood.
Ace also mentions offering commercial financing and cash-out options.
That's the life cycle approach. You buy your first home with an FHA loan. A few years later, values go up, so you do a cash-out refinance to renovate the kitchen.
Leveraging your equity.
Right. And then maybe you buy an investment property or a storefront for your business. They want to be the lender for all those stages.
They also mention helping with seller concessions.
That's another negotiation tactic. In a market where rates are higher, you can ask the seller to pay some of your closing costs. Those are concessions. Or you can use that seller's money to buy down your interest rate permanently.
But you need a lender who knows how to write that into the approval letter so the seller even understands what's happening.
Correct. If the math isn't right on the loan estimate, the whole deal falls apart.
So pulling this all together, we have the technical menu from FHA to Jumbo. We have the educational piece understanding that rates are based on risk, these LLPAs, and that pre-approvals need to be verified. And then we have the execution, that dragging the title agent to tenacity.
It's a really compelling package, and it explains why they've been around since 1996. They aren't relying on a flashy app, they're relying on competence.
So if you're listening to this and you're in the market, whether you're a first-time buyer with, less than perfect credit or a veteran looking to use that VA benefit, Ace Mortgage seems to offer that blend of high-tech tools and high-touch service.
And if you want to find them, they are located at 10181 West Sample Road in Coral Springs. Or you can call them at 954-777-4774.
And based on the reviews, someone will actually pick up the phone, even on a Saturday.
Which is the ultimate test, isn't it?
I want to leave you with a final thought to chew on today. We live in an era of automation. We want everything to be one click. We want the instant approval from the app on our phone. But a mortgage is likely the largest debt you will ever take on. It's hundreds of thousands of dollars.
It's the foundation of your entire financial life.
So ask yourself, When the pressure is on and the title company is stalling and the moving truck is idling in the driveway burning gas,
Yeah.
do you want an algorithm or do you want a Kelly?
I think we know the answer.
Thanks for diving deep with us on Ace Mortgage Loan Court. We will see you on the next one.
Goodbye, everyone.